Hi, I'm Andrew Lee, Head of Sustainable and Impact Investing for UBS Global Wealth Management. The challenges we face today as a society, both social and environmental, are complex, large in scale, and increasing by the day. Through your work, you all know this better than anyone. And we know that private investment is critical to close the gap on these challenges that we face. And families and individuals are increasingly motivated to activate their capital across investment portfolios, social finance, and philanthropy to address these goals. But it's not straightforward, and we know there are challenges, and there will be inevitable course corrections, and it takes time and patience when it comes to actual implementation against the best of intentions. We know it can be done, but it is a process. So today we wanted to share a few insights from one family's path to making their investments more impactful. I'm pleased to be joined by Stephen Hohenrieder, Chief Investment Officer of Meyer Family Enterprises, for some thoughts on the journey. Stephen, thanks so much for joining me.
It's great to be with you. Thanks for having me.
So let's start with intent. Now, your principal made the decision to invest for impact before you joined the family office. Can you share with us a little about where she started from a motivation standpoint, and how you've worked with her to calibrate those objectives on the path to implementation?
Sure. She had gone through a big life change in losing her husband suddenly and decided that she was going to make a decision to invest her capital in ways that would empower people, benefit the world ecologically, and be somewhat catalytic. And she really started out very aspirational. This was almost 20 years ago, a time when there weren't as many options for investing with impact. And so she started out very entrepreneurial, and that has evolved over time to broaden out from individual direct investments to private funds. And then we also have integrated these ideas into the public portfolios.
Super. So, when I think about implementation and taking objectives and putting them into portfolios, talk a little bit about the objectives. Were they holistic objectives? Were they very specific to an asset class or an outcome area? And then how did you take those and actually put those into the portfolio?
Sure. That too has evolved over time. What was possible 20 years ago is different than today. And so I would suggest that in the beginning, it was less structured and more driven by her interests and issues that she was interested in addressing, but also looked at impact as an overlay in every decision that she made in the portfolio. So rather than carving out an allocation toward impact, she applied a lens of values across the decisions that she was making to evaluate the opportunity to be catalytic and to support her values. And so that initially, as I mentioned, started with direct investments. She seeded some managers who were launching. More recently, we have been able to invest in managers that are established and doing wonderful work on both a large and a small scale. And then I met her through work I was doing, investing private equity capital in regenerative food systems, specifically regenerative agriculture and food companies. And so the two of us, since I joined her 4 years ago, have really spent our time looking at how we can bring more of an institutional approach to asset allocation, to portfolio construction, and to decision making around the portfolio. That includes not only how we're sourcing these opportunities and whom we're investing with, but also how we're measuring it and how we're tracking and how we're engaging with each of those managers.
So let me just ask a question actually about regenerative ag. Is that something it's clearly an important focus? Is that something that dominates the portfolio? Is it in a portion of the portfolio? How do you think about that vis-a-vis, you were mentioning asset allocation?
So the principle came from an agricultural background. She and her husband grew grapes and produced wine. She came from a more diverse ag background as well. When I joined her, I think that we probably ended up focusing more on regenerative ag because it was a mutual interest of both of ours. But it really dovetails more with the concepts of regeneration. And we started discussing something that I had been exploring over the prior decade around the role of capital. And we discussed how often the opportunities, the commercial opportunities to monetize the symptoms of an unhealthy system are so much more obvious than the opportunity to invest in the health of the system. And we decided to employ more of a systems-based approach to how we deployed capital and looked for opportunities to invest in people and projects and enterprises that contemplated social, ecological, and the capital component in their strategy and in the opportunity that we were considering. So regenerative ag is a piece of the portfolio, but it really dovetails more broadly into a interest in an exploration around the idea of regeneration and using capital to catalyze a more systems-based approach that considers all stakeholders in the system.
I think your point about systems change is so important, and thinking about that as a piece of what we're trying to achieve with portfolios. So that sounds great. I think one of the things that people always wonder about is what are the challenges? What are some of the struggles that you encounter on the path to implementing objectives? So maybe you can talk briefly about some of the challenges that you encountered when you were actually implementing these portfolios, and where you got to in terms of the end objectives.
Sure. Well, starting back in the beginning, Bonnie, the principal, publicly shares lessons that she's learned. And I think that some of the lessons that Bonnie learned and that we've observed are consistent with other families as well. And that is that so many families have a desire to support and achieve these impact-oriented outcomes. And there are a lot of investment opportunities, but sometimes it's hard to calibrate that opportunity, the opportunity to achieve that outcome with the skills of the team if you don't have deep due diligence experience. And so I see a lot of families invest in managers because they want so badly to achieve the outcome that's presented in the pitch book, but sometimes they give up their basic due diligence criteria in evaluating the team or the practicality of the strategy to actually achieve that outcome. And so while they want so badly to achieve that outcome, they don't think about the chance that there's the probability there's a 2% chance it actually it's likely to be executed. And interestingly, in regenerative food and agriculture, I've observed that there are a lot of managers being allocated hundreds of millions of dollars who literally don't have any experience investing in or operating in either the asset class or the sector. And so while I think it's incredible for people to be aspirational, I think it's so important for families to maintain their due diligence criteria and to rely on people who have the expertise to evaluate those managers, both from a practical perspective, but also in pursuing the aspiration. And so I think some of the lessons that were learned at Meyer Family Enterprises and I've observed in other families is in finding balance. It's okay for us all to be as aspirational and take as much risk as we want to. But I think it's important to be realistic and candid with ourselves about the risk that we're taking and the exposure that we're getting.
Yeah, that's such a great point. Maybe we'll close by just talking a little bit about where are you today relative to the objectives that were set out, and what's next for the family in terms of driving that impact through their investments, whether it's in regenerative ag or more broadly across the portfolio?
Sure. Well, over the past 4 years, while I've been with the family, we've spent a lot of time reflecting on investments that had been made prior to my arrival and where they would like to go, really driven by the principal, and integrated other ideas, whether it's things that I had been working on or new ideas that the principal has. And I would suggest that we've refined the strategy, and I have tried to integrate the perspectives that we've learned to narrow down how we want to get that exposure. And in some cases, we believe there are opportunities to deploy capital into private investments and have a greater impact and generate financial returns. And in others, there are opportunities to align the public portfolio with those same objectives. I think where we've ended up is with a decision to make more private investments. And given how aspirational Bonnie is, to really allocate more capital to investments where we are not taking advantage of, but pursuing opportunities to invest with more established, more sophisticated investors of private equity and debt, whether it's domestically or internationally. And we've found that those are the areas where we can have the greatest impact and also balance a desire and an intent to generate financial returns.
Yeah, that's great points. So Stephen, thanks so much for joining us. I mean, I think these are really valuable lessons for any investor, any family. But appreciate your time, and thanks for joining me again.
It's a great pleasure to be a part of it. Thank you, Andrew.
Stephen, can you talk a little bit about the different types of impact you're expecting across different parts of the portfolio, whether it's asset classes or themes or what have you, and how those expectations for the type of impact that could be achieved through various investment types, how you reconcile that with the type of impact that you hope to achieve?
Sure. So given Bonnie's priorities, we've looked at how we can integrate the values of Meyer Family Enterprises across the portfolio, understanding that different things are possible through different vehicles. That begins with our advisors and a priority around them having values that are aligned with us, not just offering an impact opportunity, to public markets, where we invest with managers who are managing for these priorities in their portfolio construction and their investment decisions. In the public markets, we feel that we can have less impact, but we can still align the strategy with our values. We look for more impact in the private markets, starting with managers. And then probably the most impactful investments we make are direct investments. We do participate through managers or single vehicles in what we would suggest are very catalytic structures, loan guarantees, and other opportunities to have an impact globally. But I would suggest that for Meyer Family Enterprises, we've experienced a sliding scale in our ability to achieve impact that is greatest on the private side, least in the public markets, but that doesn't preclude us from aligning our activities in our portfolio across all of those allocation parameters.
That's helpful. Thanks.